You finally have some money saved up, and you're ready to start investing. But when you open an investing app or website, you're hit with thousands of options screaming for your attention. Individual stocks, bonds, ETFs, mutual funds, REITs, crypto, commodities, and 100 other things you've never heard of. Everyone online seems to have a different opinion about what you should buy, and half of them are probably trying to sell you something, so you freeze. You close the app and tell yourself you'll figure it out later, but later never comes. And meanwhile, your money sits there doing nothing, while inflation quietly eats away at its value. I've been there, and I know how paralyzing it feels to not know where to start. But here's the truth. The best investments for beginners aren't complicated or exotic. They're actually pretty straightforward. And by the end of this video, you're going to know exactly what to invest in, why it makes sense, and how to get started today. Before we dive into specific investments, let me give you the framework that will guide everything. As a beginner, you want investments that have 3 key characteristics. First, they should be diversified, which just means your money is spread across many different things, so you're not putting all your eggs in one basket. Second, they should be low cost because high fees eat into your returns over time and can cost you tens of thousands of dollars over your lifetime. Third, they should be simple to understand and manage because you're not a professional investor and you probably don't want to spend hours every week researching and managing your investments. With those 3 principles in mind, let me walk you through the absolute best investments for someone just starting out. The single best investment for most beginners is an index fund, specifically a broad market index fund. Now, if you've never heard of an index fund, let me explain what it is in the simplest way possible. An index fund is like a basket that holds tiny pieces of hundreds or thousands of different companies all at once. Instead of you having to pick individual stocks and hope you choose winners, an index fund just buys a little bit of everything in a particular market or category. The most popular index funds track something called the S&P 500, which is a collection of the 500 largest companies in America. When you buy an S&P 500 index fund, you're getting pieces of Apple, Microsoft, Amazon, Google, Tesla, Walmart, Disney, and 493 other major companies all in one purchase. If you buy just one share of an S&P 500 index fund, you instantly own a piece of the entire American economy. Why is this so perfect for beginners? Because it gives you instant diversification without you having to be an expert. You're not betting on one company succeeding. You're betting that the American economy as a whole will continue to grow over time, which it has done pretty consistently for over a century. Sure, there are bad years and even bad decades sometimes, but over long periods like 20 or 30 years, the market has historically trended upward. Another reason index funds are perfect is that they're incredibly low cost. The expense ratio, which is the annual fee you pay to own the fund, is usually less than 0.1% per year. That means on a $10,000 investment, you're paying less than $10 annually in fees. Compare that to some actively managed funds that charge 1% or more, and you can see why costs matter. Over 30 years, the difference between a 0.03% expense ratio and a 1% expense ratio could cost you tens of thousands of dollars in lost returns. Let me give you some specific examples of index funds that are great for beginners. VU is Vanguard's S&P 500 ETF, and it's one of the most popular. SPY is another S&P 500 fund that's been around forever. IVV is BlackRock's version. These all do essentially the same thing, they just come from different companies. If you want even broader exposure beyond just the largest 500 companies, you could look at VTI, which holds basically the entire US stock market, including smaller companies. All of these have extremely low expense ratios and have delivered solid returns over time. Now, I need to be clear that past performance doesn't guarantee future results. But the logic of investing in the broad market is sound, and it's what many financial experts recommend as the foundation of a beginner's portfolio. Once you understand index funds, the next question is, what type of account should you invest through? This is really important because the type of account you use affects your taxes, and taxes can have a huge impact on your wealth over time. If your employer offers a 401k retirement plan, especially one with matching contributions, that should absolutely be your first stop. A 4-0-1-K is a retirement account where you contribute money from your paycheck before taxes are taken out, which reduces your taxable income right now. The money grows tax-deferred, meaning you don't pay taxes on the gains until you withdraw it in retirement. But the real magic is the employer match. Many companies will match a portion of what you contribute. Like 50% of the first 6% of your salary. It's literally free money and an instant return on your investment. If you're not contributing enough to get the full match, you're leaving money on the table. Even if you can only afford to contribute a small percentage of your paycheck, start there and increase it over time. If you don't have access to a 401k or you've already maxed out the employer match, the next best option is usually a Roth IRA. A Roth IRA is an individual retirement account that you open yourself through a brokerage. The way it works is you contribute money that you've already paid taxes on, and then it grows completely tax-free forever. When you retire and start taking money out, you don't owe any taxes on it. This is an incredible benefit, especially if you're young and currently in a lower tax bracket, because you're essentially locking in today's tax rate and avoiding potentially higher taxes in the future. The contribution limit for a Roth IRA in 2026 is $7,000 per year, but you can contribute whatever you can afford up to that limit. Even if you can only put in $50 or $100 a month, do it. That money growing tax-free for decades is a massive advantage. Now, if you've maxed out your 401k and Roth IRA, or if you want to invest money that you might need before retirement, you'd open a regular taxable brokerage account. With this type of account, you'll pay taxes on dividends and capital gains when you sell investments for a profit. But you have complete flexibility to withdraw money whenever you want without penalties. This is useful for medium-term goals or just building wealth outside of retirement accounts. The good news is that long-term capital gains, which are gains on investments you've held for more than a year, are taxed at lower rates than regular income. So it's still tax efficient compared to just keeping money in a savings account earning interest. Let's talk about another great investment option for beginners that's a bit different from stock index funds. These are called bond funds, or bond ETFs. Bonds are basically loans that you give to governments or companies, and they pay you interest over time. Bonds are generally less volatile than stocks, meaning their value doesn't swing up and down as dramatically. They won't give you the same high returns as stocks over the long term. But they provide stability and can help balance out your portfolio. A common approach is to have most of your money in stock index funds when you're young, and then gradually add more bonds as you get older and closer to needing the money. A simple bond fund to consider is BND, which holds a broad mix of U.S. bonds. If you wanted a simple two-fund portfolio, you could put 80% in a stock index fund like VTI and 20% in a bond fund like BND. And you'd have a well-diversified portfolio that covers most of what you need. There's another investment option that's become really popular and accessible for beginners, and that's target date funds. These are designed specifically for retirement investing, and they're incredibly simple. You choose a target date fund based on roughly when you plan to retire. For example, if you're 25 now and plan to retire around age 65, you might choose a 2065 fund. The fund automatically adjusts its mix of stocks and bonds over time, starting aggressive with mostly stocks when you're young, and gradually becoming more conservative with more bonds as you approach retirement. You literally just pick the fund and invest in it, and it handles all the rebalancing and adjustment for you. Vanguard, Fidelity, and other companies offer these, and they're perfect for people who want a completely hands-off approach. The downside is, they usually have slightly higher expense ratios than buying individual index funds yourself. But the convenience might be worth it for true beginners who don't want to think about allocation. Now, I need to address something that a lot of beginners ask about. What about investing in individual stocks? What about trying to pick the next Apple or Tesla? Here's my honest take. For most beginners, picking individual stocks is a mistake. It's not that you can't make money doing it, but the odds are against you. You're competing against professional investors, hedge funds, and algorithms that have way more information, resources, and experience than you do. Study after study has shown that most professional stock pickers don't beat the market consistently over long periods. So what makes you think you'll be able to do it? The time and stress involved in researching companies? Following earnings reports and trying to time your buys and sells usually isn't worth it. That said, if you really want to invest in individual stocks because you find it interesting or fun, I'd suggest limiting it to a small portion of your portfolio, like 10% or less. Use the other 90% for boring, diversified index funds. And use that 10% to scratch the stock-picking itch without risking your financial future. Let me walk through what a realistic beginner portfolio might look like. Let's say you're 28 years old. You have a 401k through work, and you want to start investing outside of that. Here's what I'd suggest. Open a Roth IRA with Fidelity, Vanguard, or Charles Schwab. Set up automatic monthly contributions of whatever amount you can afford, even if it's just $50 or $100 to start. Invest that money into a simple S&P 500 index fund or a total market index fund. That's it. You now have a solid investment strategy that will serve you well for decades. As you earn more money and can increase your contributions, do so. If you want to get slightly more sophisticated, you could split your investments between a U.S. stock index fund and an international stock index. Fun to get global diversification, maybe 70% U.S. and 30% international. Or you could add a small bond allocation if you want a bit more stability. But honestly, just investing consistently in a broad U.S. stock index fund will put you ahead of most people. One of the biggest mistakes beginners make is overthinking this and trying to find the perfect investment or the perfect time to invest. They spend months researching and analyzing and never actually invest anything. Or they wait for the market to drop before investing, but the market keeps going up and they miss out on gains. Here's what you need to understand. Time in the market beats timing the market. It's way more important to start investing consistently than to find the absolute perfect entry point. The market goes up more often than it goes down over long periods. So every day you wait is more likely a day you're missing gains than a day you're avoiding losses. Just start with whatever you have. Invest consistently and let compound growth work its magic over decades. Let me also talk about what not to invest in as a beginner. First, avoid anything that promises guaranteed high returns or sounds too good to be true. If someone's pitching you on an investment that will definitely double your money in a year, it's probably a scam. Second, be extremely cautious with cryptocurrency. I'm not saying you can never invest in crypto, but it should not be a core part of a beginner's portfolio. Crypto is incredibly volatile and speculative. Bitcoin has dropped 50% or more multiple times. It could go to zero, or it could go to $1 million. Nobody really knows. And that kind of uncertainty isn't appropriate for money you're counting on for your future. If you want to invest a tiny amount in crypto as a speculative bet, fine. But keep it to a very small percentage of your overall portfolio. Third, avoid complicated financial products like options, futures, or leveraged ETFs until you really know what you're doing. These are advanced tools that can magnify both gains and losses, and they're not appropriate for beginners. Stick to simple, boring index funds, and you'll be much better off. Another investment that often comes up is real estate, and I want to address that briefly. Real estate can absolutely be a good investment, but it's not ideal for most beginners because it requires a lot of capital up front. It's ongoing management and comes with significant transaction costs. Buying a home to live in can be a smart financial move for other reasons, but that's different from investing. If you want real estate exposure in your investment portfolio without the hassle of being a landlord, you can invest in REITs, which are real estate investment trusts. These are companies that own and manage properties and they trade like stocks. You can buy REIT index funds that give you exposure to real estate without having to buy actual property. But honestly, for most beginners, focusing on stock index funds is simpler and more effective. Let me share a perspective that might change how you think about investing. When you invest in index funds, you're not just buying pieces of paper or numbers on a screen. You're becoming an owner of real businesses that provide real value to the world. You own a piece of the companies that make the phones we use, the cars we drive, the medicine that saves lives, the software that powers the internet. These companies employ millions of people, generate billions in revenue, and create products and services that improve our lives. When you invest in the market, you're betting that human innovation and productivity will continue, and that bet has paid off throughout history. That's a much more solid foundation than trying to guess which individual company will beat expectations next quarter. I also want to emphasize the importance of staying the course once you start investing. Markets will go down. There will be recessions, corrections, and scary headlines that make you want to sell everything and go to cash. This is where most people fail. They invest when times are good, panic when times get bad, and sell at the worst possible time. Then they wait for things to feel safe again before getting back in, which means they miss the recovery. The investors who build real wealth are the ones who stay invested through the ups and downs, who keep contributing even when the market is falling, and who resist the urge to react emotionally to short-term volatility. Remember, you're investing for decades, not days. A market drop this year is completely irrelevant if you're not retiring for 30 years. One more piece of advice that will serve you well: ignore the noise. Financial media makes money by keeping you engaged and emotional, so they hype up every market move and make it seem like you need to react. You don't. In fact, the less you check your investments, the better you'll probably do. Check in quarterly, or even just once or twice a year, to make sure you're staying on track. Rebalance if needed, and then go live your life. The best investors are often the ones who set up automatic contributions. Invest consistently, and then forget about it for years while the money compounds in the background. Before we wrap up, I need to remind you that everything I've shared here is for educational purposes only, and not financial advice. I'm not a financial advisor, and your personal situation is unique. You should do your own research and consider consulting with a licensed professional before making any investment decisions. My goal is to give you a solid foundation and point you in the right direction. But you need to take responsibility for your own financial choices. So here's what I want you to do after watching this video. First, if you have a 401k available through work, make sure you're contributing enough to get the full employer match. That's free money you can't pass up. Second, if you don't have one already, open a Roth IRA with a reputable brokerage like Fidelity, Vanguard, or Schwab. Third, set up automatic monthly contributions of whatever amount you can afford. Fourth, invest that money into a simple, low-cost index fund, like an S&P 500 fund or a total market fund. And fifth, commit to staying consistent and not panicking when the market drops. Do these 5 things, and you'll be ahead of 90% of people when it comes to investing. The investments I've covered today aren't sexy or exciting, and they won't make you rich overnight. But they're proven, reliable, and accessible to anyone regardless of how much money you have or how much you know about investing. The best investment you can make is the one you actually follow through on. And simple index funds give you the best chance of staying consistent for the long haul. If this video helped clarify what you should actually invest in as a beginner, I'd really appreciate it if you hit the like button. And if you want to keep learning about investing, money management, and building wealth the smart way, go ahead and subscribe to the channel. In the next video, we're going to talk about the biggest mistakes beginner investors make and how to avoid them so you don't lose money unnecessarily. Thanks so much for watching, and I'll see you in the next one.